We are Group 8 and are presenting the leveraged buyout of Philips Semiconductors to Bain Capital, Alp Invest, KKR, Silver Lake, and Apex Partners. The presenters are Jeremy Kohler, Nathan Thompson, Dane Strew, Michael Godfrey, Jody Colm. In the history of Philips Semiconductors, Philips Electronics is a Dutch company headquartered in Amsterdam. Founded in 1891 by Gerard Philips, Philips is one of the largest electronics companies in the world. Philips is organized into three main divisions: Philips Consumer Lifestyle, Philips Healthcare, Philips Lighting, and as of 2012, Philips is the largest manufacturer of lighting in the world. In March 2012, Philips announced its desire to sell or to merge its television manufacturing operations to TPV Technology.
Philips Semiconductors at one point in time was the sixth largest semiconductor company, and in December 2005 they announced their intentions of legally separating into a separate legal entity. At first, Philips was going to go with an IPO for the division, but then decided to go with a leverage buyout. The reasoning behind selling the company was because of how much fluctuation throughout the year it affected their business earnings overall. And so to increase the company value, they felt that they should sell it. The companies that were involved in this leverage buyout were KKR, Alpine Invest Partners, Bain Capital, Silver Lake Partners, and Apex Partners. They paid 8.3 billion euros or $10.6 billion for those shares. Philips did end up selling 80.1% of the shares to the fund participants while retaining 19.9% of the company. In September 2006, the transaction was complete. They ended up selling the 80.1%. This transaction also included changing the name of the company from Philips Semiconductor to NXP Semiconductors, and they said that NXP stood for the next experience, and that's how they wanted the company to be viewed. The private equity investors included KKR, which happened to be the leading firm for the transaction, Bain Capital, Alp Investment, and these companies, their brief history are: Alp Investment was established in 1999. Their main focus for their investments are private equity, and right now they currently hold 59.2 billion assets under management. As for Bain Capital, they were established in 1984. They tend to focus on venture and expansion capital for private companies, and they currently have 64 billion assets under management. KKR was established in 1976. They happen to be the first firm to be involved in a leverage buyout that exceeded an excess of $1 billion. Their typical focus are fixed income investment mandates, and they currently hold $18 billion under management. The final two are Silver Lake Partners and Apex Partners. Silver Lake was established in 1969. Their typical focus are on five main growth sectors, which is technology and telecom, media, retail, healthcare, and financial and business services. Right now they approximately have 40 billion assets under management. And then Apex was established in 1999. Their main focus are the large upcoming technology companies, and currently they have $16 billion under management.
Royal Philips, the parent company of Philips Semiconductor, maintained an investment grade rating of A3 by Moody's. The breakdown of the debt used for the transaction is as follows. 3 billion euros of senior secured debt was issued. Moody's assigned a provisional credit rating of Ba2, which falls under the speculative grade category. Another 1.5 billion euros of senior unsecured debt was issued. The unsecured debt was given a slightly lower provisional rating of Ba3. Although Royal Philips was to maintain a 19.9% stake in the sold company, the credit ratings did not assume any implicit or explicit support from Philips. That is why the debt issued for the LBO transaction received a speculative credit review. However, the earnings outlook remained positive despite the speculative credit rating. The valuation and financial ratios are depicted in the table and graph below. The leveraged buyout consisted of 53% debt, or 4.5 billion euros, and 47% equity, or 4 billion euros. These levels are quite conservative, considering that many transactions compose of 90% debt and 10% equity. In the time since the leveraged buyout, the EBITDA has fallen from 1.177 billion to 972 million, which is a 17% decrease. Unlike most LBO transactions, the buyout of Philips Semiconductors involved relatively low levels of debt. Average leverage ratios are around 5 times, whereas in the Philips LBO transaction, the leverage ratio was 1.13 times. Royal Philips entered into the LBO transaction with private equity partners to divest itself of Philips Semiconductors on the grounds that the business was prone to volatile swings. The volatility of the semiconductor business made it more difficult for Philips to forecast accurately. The volatility of the business is evident in the stock price data. Philips Semiconductors has seen volatile swings in their share price, which have resulted in a beta of 3.58, far above the market beta of 1. The private equity firms decided to sell Philips Semiconductors to the public in an IPO. In August 2010, Philips Semiconductors was sold to the public at the price of $14 per share. The IPO price was at a steep discount in comparison to the price paid by the private equity partners. It sold at a 46% discount. The private equity consortium used the proceeds of the IPO, about $4.5 billion, to pay off the secured and unsecured debt that was issued for the LBO transaction.
The semiconductor market has been very attractive for investors. With the ever-changing technology advancements, demand for semiconductors has brought many manufacturers into the market. In 2006, private equity investors viewed the semiconductor manufacturers as cash cows. Philips had several other offers from private equity groups and had initially planned to go with the IPO before they decided on the leveraged buyout. For Philips to go with a leveraged buyout at this time was not common because of the nature of their business. Typically, this type of transaction would have been financed from a bank loan or from cash. The semiconductor market has changed significantly since the initial leveraged buyout took place. The top competition for NXP includes Intel, Samsung, Texas Instruments, and Toshiba. Year-end data for 2011 shows the semiconductor market share as the following. Intel Corporation ranked number 1 as the industry leader with 15.9% market share. Samsung, the largest technology company in the world, at 9.3%. Texas Instruments at 4.5%. Toshiba at 4.3%. And NXP is currently ranked number 17 at 1.2% market share. At the time of the LBO, NXP was one of the top leaders in the semiconductor market share. Regulatory issues are the European Union has formulated regulations to address excessive leverage, conflicts of interest, market abuse, and a general lack of transparency do not take place. This regulation is known as Article 23. The Euro's concern is that target companies may be stripped down to service debt and make a quick return to the buyers. Before Philips could finalize the deal with the private equity groups, they had to satisfy the requirements of this Article 23 by presenting the details of the transaction to the European Union.
This LBO transaction was valued at 8.3 billion euros, of which 1.9 billion euros went to taxes and fees, which left Philips with a 6.4 billion euros after taxes. And the consortium assumed $5 billion in in debt and liabilities.